So what's up, guys? It is 15th of June, Monday, and I have got a rather interesting topic to share with you today. It is the rule of 72. So before we even move forward, I've got like this huge disclaimer to make. It is a topic which will teach you to make more money. So if you don't like to make money, or if you're allergic to money, or if you've just got a problem with it somehow or other, stop watching, scroll down, do something else. Don't waste your time. Okay. So basically, the rule of 72, what it is. Okay, so the rule of 72 is a very simple financial formula which helps you calculate the amount of time it will take for your investment to double up. Okay, so basically, we want to calculate, like, if I've invested 10,000 today, how long will it take for us to make it into 20,000? Okay, so let's just quickly jump into it straight away. Let me share a whiteboard. So basically, this is the, I'll make this large. So the formula is very simple. 72 divided by the interest rate. Interest rate that you'll receive will equal to how long amount, length, how do I say this? Length, amount of time for it. Amount of time to double up. Okay, so that's basically it. Okay, 72 divided by the interest rate, it will equal to the amount of time to double up. Okay, so now let's look at the first example. So 72, let's just say now, if you are can we change the color? Hold on, guys. So I just want to see if I can change the color here. So no, so everything changes. Okay, that's okay. We'll just pick up another text box. So now let's look at a couple of scenarios. 72. All right. So 72 divided by 3% in this instance, in this case, would be something close to what your FD returns would be. 70 divided by 3 is 24. So it would take you 24 years to double up your money if you've kept it in a place where it bears you about 3% interest. So now let's go into, let's just put fixed deposit here so that we can refer to it as well. So fixed deposit. So I know most of you guys be saying like 3% is like too much right now. I know, I'm just doing it for the calculation's sake. And I'm going to show you actually, I know interest rates have dropped to 2% now. I'm going to show you the difference that 2 and 3% can do as well to you. Okay, so we'll do that at the end. Okay, so now let's go back to what we're doing. 72 divided by, let's just say 6%. This is what your EPF, your Providence Fund, will give you, okay, on an average. I know it was a bit lower last year, but the years before were about 6%. So let's just keep 6, okay? So 72 divided by 6 is about, I think, 12 years. Yep, 12 years. And this would be your Providence Fund. Okay, so again, if you've kept 10,000 in your Providence Fund, in 12 years, it will become 20,000. So simple, so far so good. Okay, so now let's look at unit trust. Let's look at a very moderate risk unit trust. Let's look at about 9%. Okay, 9%, and it will take you about 8 years, correct? Yes, 8 years to double up. Now, unit trust, medium risk. Mid risk, unit trust. Now, let's look at a slightly more attractive number, 72 divided by 12%. So this is when markets are really good. The truth is we can get 12%, but I don't want to say that these things are often, but they do happen. Okay, people who have invested for a long time, they have received 12, 14%. Fine, but we just want to stick to 8 to 9. But let's just look at it. 12%. If you get it, what happens? Okay, so you get to actually double up your money in just a matter of 6 years. Okay, so that's basically it. Very quickly, let me sum it up. So 72, the rule of 72 is 72 divided by your interest rate that you're receiving, and that would be the amount of time that you will take to to double up your money. So in this instance, if you've a fixed deposit, what is this, believer, and if you just say no to any risk, your 10,000 will take you 24 years to double up. Okay, so that's basically it. So now I'm going to just quickly compare 24 years, this part here, and I'm just going to quickly compare 9%. Okay, so we'll just do these two. We'll leave the 12% away. We'll just look at the potential. Fine. Let's just take a very conservative 9%, and we'll look at 24%. And we'll see what is the difference in that time period. Okay, so I'm just quickly clear this, and I'm going to draw a timeline for you guys. Very simple timeline. So this timeline will represent 24 years. So 24 years. Okay, and you started with RM 10,000. Simple. We're not even looking at a big number. Okay, at the age of whatever age you are, and maybe 30 years old. Okay, so let's just say at 30 years old, you invest $10,000. Okay, and if you've invested at 3% return, and you like you know, FD 3%. Let's look at that. So at 3%, you would have, where's my percentage? At 3%, you would have 20,000 at the end of 24 years. Now let's look at the magnitude of the difference. Okay, so far so good, right? 10,000, 3% in 24 years, you make about 20,000. So let's look at if we just increase it into mutual fund savings and public mutual, sorry, how can I always say that? Unit trust savings and Manulife savings. Okay, so we kind of double up every 8 years. Okay, so this is 24, and let's just say that in 8 years, the first 8 years we double up. Okay, so this is the first 8 years, and then 16 years, and then 24 years. So what happens is very, very simple. You must be getting the flow at 6%. Sorry, at 9%. You'll be making, so doubling up here on your 6th year. So your money will be 20,000. And then add your 16th, 16th, yes. 16th year, you would be doubling up your money at 40,000. And then when it reaches 24 years, same length, guys, you have 4 times more, $80,000. Okay, so that's basically very, very simple calculation. 3% versus 9%. So your 3% over 24 years is 20,000, and your 10,000 over 24 years at 9% makes you $80,000. So like, all you need to do is just get your understanding right, and you are $60,000 richer by the end of 24 years. How, that's just amazing, guys. Okay, so that's a huge sum. Okay, huge difference. Okay, so that's just one of it. So I'll show you another calculator, which is what we use all the time. Stop share, and I'll share something else for you guys. We can look at some numbers here. So okay, so I'm just going to increase the numbers to about 100,000, so that we just want to see the magnitude of the difference. So let's just say you're 30 years old. Okay, you're 30 years old, and you have about 100,000 to invest, and you have a 25 years, you know, like okay, let's just say you're 35. Okay, 35 is a bit more logical to have 100,000. So you're 35 years old, and you plan this one for like 25 years forward at the age of 60. Okay, very fair, very, very doable. 100,000 for 25 years. If you've just kept that 100,000, just kept that 100,000 in your fixed deposit rate at a 3% return. At the end of these 25 years, you'd have $211,000. Okay, yeah, whatever. So now, if you've left that same amount of money in your providence fund, which gives you close to 6%, you would be looking at double. Okay, which is quite a lot, $446,000. Okay. So I just wanted to write down the 3% so that we can know the difference. 211. Okay, now let's just look at 9. Okay, look at 9%, and suddenly the number becomes $940,000. Now this is huge, guys. Okay, you started off at 3% FD rates at $210,000, guys, and now we're looking at $940,000 over 25 years. That is a difference of 730,000 ringgit. It's huge. $730,000. If you don't like that, just give it to me. You know what I mean? But that's the reality of things. You know, the difference, that the magnitude of this 1-2% is massive. It is so big that that we need to educate ourselves. We need to tell ourselves, like, look at these numbers. These are real numbers. You know, 9% is very, very achievable. Okay, 8-9%, 8%, Carlo, make it 8. Still 734,000, still $500,000 more than what you'll receive if you just left it in your fixed deposit boxes. Okay, now let's look at something more challenging, more attractive. Okay, so let's just look at like the maximum of what I believe unit trust can hit. You know, and if I mean, of course, they hit 13, 14, they hit 18% a year, but this is like, how do I say? Let's be realistic. Okay, let's keep 12. So if you've done the same amount of investment, 12, you're looking at, guys, close to $2 million, which is effectively 10 times more than what you'd have if you've left it in your fixed deposit. So now 3% or 12%, leave 12. Let's just go back to 9%, which is already $730,000 more. Now, if this doesn't educate you, I'm not sure what will. Okay, so now let's look at another reality. The other reality is, a couple of days ago, interest rates have been dropped to 2%. Just 2. Okay, I'm going to go into like super depth about this FD rates in maybe a next topic or the one after. I'm just going to touch a very little bit right now. Okay, so 2%. What happens at 2%? So at 2%, 25 years, you have a savings of 164,000. 164,000. Okay, so I want to show you what happens if you just increase it by 1%. What does this 1% reduction does? Is it gives you about $60,000 less over that period of time. So now, the truth of the matter is, you're getting 2% now, guys. 2% over, like I said, this huge long period of time. Let's just say, like, you know, you're not a very long-term investor. You just want to keep it 5 years. So 2% over 100,000 for 5 years is just $10,000. Okay, and if you do another conservative 6%, you're looking at about $2,000 more. So sorry, 5%, wrong place, 6%. You're looking at least $25,000 more, even if you want to keep it in the short-term period. So guys, this is the rule of 72. It is a very, very powerful tool. It is how do I say, it is just the basic, super duper basic calculation of like knowing how much your money can double up. And I've showed you the numbers, showed you the guys. So now just make an informed decision. Don't look, the worst thing you guys can do is leave your money in FD in this period of time. Okay, unless of course you need liquid funds, that's fine. But like if you're investing, you're looking to invest for the long term, 5 years and above, putting money in FD is an absolute disaster. Okay, we'll get into more depth on this topic, why FDs are a bad idea, maybe in a day or two. But basically, you get my point. FDs versus unit trust, $700,000 difference. You know, if you get better interest rates, it can go up to like $180,000. it's 10 times more. What's the big deal? You know, start making good decisions, make strong financial decisions, follow the strategies, speak to me, I'll teach you how it's done, and I'll, like, you know, guide you step by step, and we'll get it right. Okay, so that's basically it. I hope you've enjoyed the session. So yeah, so the fact that you actually watched to this end, you're definitely not allergic to money, so do give me a call, and let's just sit down and see how we go. All right, take care guys, see you soon.